Breaking news, a global sell-off underway. Steep losses in China forcing regulators there to halt trading for the second time this week. U.S. markets, European markets following suit. I will note, Dow Jones futures well off the lows of the morning. We were down more than 400 points, 349 points. But it's been a 500-point loss on the Dow alone so far this week. Let's bring in Wall Street Journal Chief Economics Correspondent John Hilsenrath. Phil Flynn also standing by at the CME. John, what did the folks at the Federal Reserve start talking about given the start to this year?
Well, you know, we got minutes from their December meeting out yesterday, and what we saw was a group of people who, even though they raised interest rates for the first time since 2007, they're very squeamish about what they were doing. They're worried that inflation is going to continue to be below their 2% goal. And, you know, the Fed is saying it's going to raise rates 4 times this year. The market says 2 times. The way things are going, it looks like it's closer to what the market's saying than it is what the Fed is saying.
But that begs the question. It's a question that was raised by a lot of people before the Fed even made its move in December, John. Why the heck did they do it? If they were squeamish about it, why the heck did they go ahead and do it? Now, you can write it off and say it's only a quarter of a point, but nonetheless, it's a rate hike.
Right. Well, there's a few reasons for this. You know, one is we have seen an improving job market in the United States. The unemployment rate has come down to 5% from 10%, and broader measures of unemployment have also come down when you take account of part-time workers and people who have dropped out of the labor force. All these indicators have been improving, and at some point the Fed has to respond to it. You know, so what they wanted to do is, you know, despite their squeamishness, they wanted to get started, because if things do keep getting better, they don't want to end up behind the curve.
John, and correct me if I'm wrong, I think that you wrote an article, it was in September maybe, where the Fed, after the market shock in August, actually was looking at the new extraordinary measures it could go to if it needed to put more juice into the markets and the economy.
Well, this is the problem that they've got is, you know, they think the economy is getting stronger. They think they're going to be able to keep raising interest rates for the next couple of years. That's their baseline scenario. But they worry a lot about some new shock hitting the economy and being in no position to do anything because interest rates are so close to zero, and they've already got such a big balance sheet. They're very worried that there's a new gunfight and they're out of bullets. So they do spend a lot of time thinking and talking about that.
John, you appropriately pointed out that the Fed fund futures are pointing to like a couple rate hikes. How about the bond market? What do you read through on that? Either the credit signal or bond yields today, 2.14% on the 10-year itself. You think the Fed will pay attention to either of those market signals?
Yeah, I think they will. You know, I think back to the bond market conundrum of 2004 to 2006. The Fed was raising interest rates and long-term interest rates didn't move anywhere. You know, it was a signal that there was a weight on interest rates that the Fed shouldn't and couldn't ignore. And, you know, I think that when they see low 10-year Treasury yields, they say there's no inflation pressure and they don't have to move very aggressively.
Yep.
Hey, John, so this China news out this week that's really affecting the markets, the Fed's obviously watching that, and they told us in the meeting two meetings ago that they were keeping an eye on what was going on in China. Can they use the China news as kind of a reason to back off right now, or do you think they have a number in mind where they want to get to, say, 1% by the end of the year, and they're going to get there regardless of what goes on overseas?
Well, I mean, they're not going to use China as an excuse. You know, the two things that they're looking at are inflation, which has been running below 2% here in the U.S., and unemployment. And if inflation doesn't move up, then that's their excuse. And frankly, if the world's second largest economy, if the world's biggest commodity consumer continues to struggle and disappoint, there's going to be a lot of downward pressure on inflation, and that's what could force the Fed to hold its fire.
Really quickly before we have to let you go, John, Jim Rogers said if he was the head, when Mike Block asked him if he was running the Fed, he'd go in and abolish the entire central bank and then resign. We laughed at that. However, do you expect to hear more of that from the campaign trail, especially from the Republican presidential candidates? And how did those candidates potentially influence what the Federal Reserve does in the next year?
So I'd say two things about that. One is, to answer your question specifically, yes, I think the Fed is going to be a political issue in 2016. It's going to make their job more difficult this year because Republicans are going to be attacking them about mismanaging the economy and about being too powerful and too unwieldy. So that's the first thing I would say. It is a political issue. But the second thing I'd say to Jim Rogers is, that's a nice laugh line, but tell me, what would you put in its place? You know, it's very easy to attack the Fed, but when you start thinking about the alternatives, it starts getting a lot more complicated. Do you want to run this economy on gold? Okay, well, gold has been a very volatile commodity over the last few years. You know, if we've been running the economy on gold for the last few years, our money supply would have shrank dramatically. We'd be back in a depression.
Yeah, and by the way, who are the biggest producers of gold in the world? China and Russia. So let's link our economy to those very stable nations.
Oh, wait, let's Russia, but let's also not forget South Africa and a number of other countries. And you know, it's not like these are the countries of the world that we want to tie our economic futures to.
Right. John, good to see you. Thank you so much. John Hilsenrath of the Wall Street Journal.